Level 1, the Claims Adjuster. You're 19. Associate degree. Sitting at your desk in the claims department, reviewing the third vehicle damage estimate of the day. The system says the repair should cost $2,400. The actual invoice says $1,900, AA $500 gap. Not dramatic. Nobody's going bankrupt over it. But it is wrong, so you flag it. Your supervisor spends half the afternoon tracing the number through the system. Eventually he finds it, an old parts price table, entered 3 years ago. Never updated. You don't know who built that table. Don't know who approved it. Don't know why the same wrong number sat there for 3 years without anyone touching it. You just know the system spit out an answer, and until you questioned it, everyone treated that answer as fact. Your salary's $4,200 a month. This job doesn't require a single certification. Most days your job isn't to understand how a number got made. Your job is to process it. But that $500 stays stuck in your head. That night after work, you search 2 words on your computer. Actuary. Exam P. At the time, registration costs $235. Pass rate around 40%. You read that twice. 40% means most people fail. It also means some people pass. At 19, that feels like enough of a plan. You register. You don't know it yet, but the gap between the person who processes a number and the person who is actually signed responsible for that number is going to take you 10 years to close. And it starts with $500. Level 2. The degree. You're 20. You enroll in an adult self-study bachelor's program. Financial mathematics. Tuition's $3,800 a year. You do the math immediately, because apparently that is who you are now. Pass every course first try, and the degree still takes 4 years minimum. At the same time, you sign up for Exam P exam day. You show up 7 minutes late. Doesn't sound like much in normal life. In an actuarial exam room, it feels like showing up next Thursday. The proctor makes you write a late explanation before you're even allowed to sit down. 3 months later, the result lands passed. Not comfortably, but enough to move forward. You print it out. Set it next to your claims adjuster pay slip. One paper shows what you make now. The other shows the direction you're trying to drag your life. Then you do the math again. You count the exams, modules, and remaining requirements. Even if everything goes smoothly, the full FSA designation is another 9 or 10 years out. That is the optimistic version. The one where you complete every exam and requirement, finish the degree, keep the job, and somehow still function like a normal person during exam season. $4,200 a month. 1 exam down. 9 or 10 years to go. You keep going anyway, because long timelines are terrifying if you stare at the finish line. Much easier to manage when the next step just needs a registration click. Level 3. The transfer. The degree arrives in a thin envelope. On the same day, the actuarial department posts an internal opening. You're 23, and for once, the timing looks perfect. Requirements: bachelor's degree, at least 2 exams passed. You qualify on both counts. You apply. 2 weeks later, rejected. 1 sentence: the actuarial department has reached its staffing limit for the year. Nothing wrong with you, just no chair available. So you go back to claims. Stay there 11 more months. Pass another exam in the meantime. Also, nobody asked you to do this. You build your own report analyzing 2 years of processing error rates. That is exactly why it matters. Next opening, you apply again, this time with 3 past exams and that self-made error rate report attached. This time, accepted. Your title changes to actuarial analyst. Your salary jumps from $4,200 to $7,800. The extra $3,600 changes your budget. Being trusted to build the numbers instead of simply processing them changes how you see the work. Your first solo assignment: calculate the base rate for a new auto insurance product. You build the model, check the assumptions, run it. Your result comes out 7.6% lower than the number from a colleague with 8 years of experience. You've got a new title and roughly 5 minutes of confidence. You could just submit it. You don't. You bring it to him instead. He spends 40 minutes going through your work, finds it. For one age group, you used a 2016 industry benchmark instead of the company's actual 3-year data. Your math was correct. Your assumption wasn't first real lesson of the job. A perfect calculation on a wrong assumption is still a wrong answer. You rerun it. The gap drops from 7.6% to 1.3. That 1.3% makes it into the official pricing plan. Level 4. Between exams 6 and 7, you're 26. 6 exams down. The 7th is fellowship level, covers an entire insurance company's solvency. 4-hour exam. They hand you a fictional company's financials and expect a full risk response plan back. The company exists only on paper, but after 4 hours with its balance sheet, your body doesn't seem to know the difference. You burn 2 weeks of annual leave prepping. During those 2 weeks, you say roughly 1 sentence to your boyfriend in the morning and 1 at night. Your relationship briefly turns into a very efficient daily news bulletin. Night before the exam, he cooks dinner, leaves it on your desk. You remember to eat it only after it has gone cold. Not trying to be dramatic. You genuinely forgot dinner was part of the schedule schedule. Results day. You're sitting in a team meeting when your phone buzzes on the table. You flip it over. Look, the meeting's still going when you put your head down on the desk and start crying. Your supervisor thinks something's wrong. You look up. It is okay. Every results looks small from the outside for years now. One word, past dead. But that word's carrying every weekend you gave up, every dinner that went cold, every morning where the first thought in your head wasn't about work, it was about the next exam. The result is one word. The cost behind it runs a lot longer. Level 5, FSA, you're 29. You complete the final requirement. You're an FSA now, a fellow of the Society of Actuaries. You started at this company at 19, 10 years to get here. About 3 years longer than the industry average. Not because you were slow, but because before you could even start the professional path, you had to build the academic one underneath it first. HR runs the announcement in the internal newsletter. Headline says you're the only employee in 5 years to transfer from a non-actuarial role and still land the FSA. You print the certificate, hang it on your cubicle divider. One day your old supervisor from claims walks by, stops, looks at it for 2 seconds. I still remember that damage estimate, the $500 gap. He keeps walking. You look at the certificate, then at the empty space beside it. Level 6, the weight of pricing the number on your screen is 14%. You check it again, then once more, you're 34, repricing a critical illness product. And the model is telling you to raise premiums % for one age group. You already know the model isn't the difficult part. The difficult part is walking that number into the sales department. 14% isn't abstract to the sales team. To them it has a face. Fewer new policies, smaller commissions, harder conversations at the counter. The head of sales comes to your office, tells you this increase is going to tank new business. He is probably right. You lay 3 years of claims data on the desk in front of him. For this age group, critical illness incidence is nearly 40% higher than the benchmark set 10 years ago. The old price is easier to sell. It is also built on a world that doesn't exist anymore. The proposal goes through. Product launches at the higher rate. 6 months later, new policy volume has dropped, exactly like sales predicted. But the claims ratio stays in a healthy range. Your supervisor writes one line in your annual review. This decision withstood short-term pressure and protected long-term solvency. Nobody applauds when a pricing call prevents a crisis that never happens. That is the strange thing about this job. When you're wrong, everyone eventually notices. When you're right, the company just keeps running. Nothing happens. Your job is making sure nothing happens. Stays a possible outcome. Level 7. The Chief Actuary 42. You become Chief Actuary. Every year your signature goes on the actuarial report, telling regulators and shareholders the company set aside enough money to cover its future obligations. The report's hundreds of pages. The signature is just your name. The responsibility lives in there anyway. During a routine regulatory review, an examiner questions the interest rate assumption your team used on a long-term care portfolio. Says it is too optimistic. You run your team through 10 straight days of extra work. Rebuild the sensitivity analysis. Test alternate scenarios. Recheck the long-term liabilities. In the end, you lower the assumption. That single change adds nearly 50 million yuan to the company's quarterly reserves. 30 million doesn't just quietly disappear off a balance sheet. The CFO asks in a meeting whether the adjustment really needs to happen. You understand exactly what is behind that question. It hits earnings. It hits targets. It means explanations senior leadership will owe people who weren't in the room when the numbers were tested. But the numbers don't get less true just because they're inconvenient. You answer, this isn't something we have room to reconsider. This is the floor professional ethics requires. The room goes quiet. 30 million yuan moves into reserves. Quarterly earnings take the hit. The company becomes harder to explain and safer for policyholders to rely on. Level 8, the handoff 53. You're training a new batch of analysts. One of them transferred over from underwriting. Just passed exam P, pass rate still under half. She asks how you made it through the whole thing. She is expecting advice, a study schedule, maybe a revision trick, possibly a secret method involving color-coded notes and the complete elimination of sleep. Instead, you take her to the archive room, dig out an old vehicle damage estimate that has been filed away for 33 years, papers yellowed at the edges. That original Feinyuan gap is still marked right there on the form. This was the first mistake I ever caught. You tell her, 19 years old. It was also my first step into this whole thing. You didn't create the error. You were just the first person who refused to let the number pass without an explanation. Why did the system say $2,400 when the invoice said $1,900? assumption? Who set that assumption? When was it last checked? What happens when nobody checks? That question followed you through the degree, through exam P, through the rejected transfer, through the model that came in 7.6% too low, through the fellowship exam, through the fellowship exam, through the POV percent rate hike, million reserve adjustment. On paper, the career is a list of exams and job titles. In practice, it is the same professional habit repeated at higher and higher stakes. Somewhere right now, a 19-year-old is sitting in a claims department, working through the third damage estimate of the day. The system's given a number. The invoice says something else. The gap is only $500. They don't know who entered the old table, don't know why nobody fixed it, don't know that one small discrepancy can lead to a bachelor's degree, years of professional exams and requirements, a chief actuary's signature, and a decision worth tens of millions. They just know the number's wrong, so they flag it. That is how the career starts. Not with a title, not with a certificate, not even with math, with deciding to stop just processing the number and start asking where it came from.